Hello, good morning, guys. This is Max GFX. Welcome to Make Money Online Forex Trading Beginner Guide Lecture 2. All right, on our first video, we discussed these key contents. The first one is the what is Forex trading, how Forex trading works, why people trade Forex, and major players in the Forex markets. And lastly, the tools you need to start. Okay, so I would advise that if you haven't watched the first video, please go back to go and watch in order to build on your knowledge so that you don't get confused in this lecture slide. All right, so fast forward, we'll be discussing this key content on lesson 2. That's explanation of key terms, types of financial markets, how forex trading works, risks in forex trading, successful entrepreneurs in forex trading, requirements of forex trading. All right. So let's take the first one. So explanation of key terms. So the first key term here is bulls. So when you say bulls, or if you have heard of bulls in forex trading, this means people who buy. So the bulls represents the buyers in the forex market. So the bulls represent those who speculate that the price of an asset or the price of a currency would rise. So those are the bulls. And the bears are the opposite of bulls. So these are the sellers in the market. And they speculate that the price of an asset or a currency would fall. So yeah, so these are called the bears. And a bearish candle. So when we say a bearish candle, so a bearish candle represents the number of uh, uh, sellers in a particular particular time frame. So a bearish candle represents the amount or the number of sellers in a particular time frame. And we say a bullish candle. So this also represents the number or amount of buyers in a particular time frame. In a particular time frame. Okay. So the next one is liquidity. So liquidity is basically the aggressiveness of buyers and sellers. So when you say liquidity is the how how uh, how fast or how aggressive the buyers and sellers are. So in the forex market, there might be times that the market is not so much aggressive, which means that there's no liquidity, there is no fast movement in price. So yeah, so if they and there are times too that there are fast movements in price, and those times we call it there's liquidity in there. There's liquidity. All right. So the next one is psychology. So forex trading, when you say psychology, it's a state of mind. It's a state of mind that everyone wants to be. And in that state of mind, you have control over yourself, control over your decisions, control over your emotions. So psychology is a state of mind in which you have control over yourself, control over your emotions, control over your decisions in forestry. And this tells us that there are times you'll be in the market and you don't have control over yourself, which means you make impulsive decisions in the market. And that makes you make mistakes and losses, take losses in the forex market. So psychology. Okay, so the next one is risk management. So when we talk about risk management, so risk management is you being able to protect your capital in your forex market. You know when to enter the market, when to exit, when to increase your lot sizes, when to decrease your lot sizes, when to trade, the time to trade, the session to trade. So these are the decisions that all make up the risk management. And when you have a good risk management, then you are a successful trader. Yes. All right. So let's go to the third point, which is the types of financial markets. So we have the main financial markets. That's the first one is the Forex market, the stock market, the commodity market, the cryptocurrency market. So the Forex market is what you are dealing with right now, which is the selling and buying of currencies, and the stock market which deals with the selling and buying of shares. So the shares of a company uh, or 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 businesses. And the next one is the commodity market. So when you talk about the commodity market, this is the gold, the oil, and all the sugars, the the maize, all those things. So those fall under the commodity markets. All right. So the cryptocurrency market. So if you have ever heard of cryptocurrency or come across a word like cryptocurrency. So cryptocurrency just represents the money that we use. It's the money that we use. So the CDs, the dollars, but it's not physical. So it's just like the money we use, but it's not a physical money. It's the money that is being used only online. So it's only available online. It's not a physical money that we use, but it works as the same money, but just that it is not physical. It is not physical. It is an electronic money. Electronic money. Okay, so that's the cryptocurrency market. So an example is the Bitcoin, Ethereum, Solana. So all those fall under the cryptocurrency market. And the next slide talks about how forex trading works. So in forex trading, the first one, so there's a buyer, there's a seller, there's a broker, there's an open interest, there's a closing trade, there's an open interest, and seven, there's profit and loss. So the question is, who is a broker and what is an open interest? Okay, so this how the forex trading work. It's just like a normal market. That in a normal market, you need a buyer and a seller in order to transact business. So in the forex market too, we need a buyer, we need a seller. But instead of dealing straight with the buyer or the seller, we need to pass through someone, which is the broker. So the broker is just someone between the buyers and sellers. They help transact businesses. They help match uh, buyers and sellers. Match buyers and sellers. And this is very important because when you go to the normal market, if I want to buy tomato, five tomato, and I want to pay 5 cedi for that tomato, or $5 for that tomato, I want to buy tomatoes. I want to buy just five, and I want to pay $5 for that. So which means that I am the buyer, I'm going to the market. So it means that I have to get a seller who also wants to sell five tomato and receive $5 and receive five. So this is done by the broker. So the broker just matches them. He sees those with the same money and same amounts that they want to transact business, and they just link them. They do it. So that's the work of the broker. So in simple terms, the work of a broker is to fill orders. That's the work of a broker. Okay, so when a broker fills the orders, it's called something, it's called an open interest. So when the broker is able to match a buyer to a seller, then it is an open interest. And in forex trading, when there's an increasing open interest, which means there's an a more higher probability of continuation of a trend. Yes. All right. So after so yes, so they become one open interest. So just one open interest. All right. And now when so let's go back small. So when they place a buy, so when a buyer wants to buy, it means that it means a seller. And now a broker and this broker they fill the order, they become open interest. And now when these people close are closing the trade too, they they become the broker has to also fill those orders, not necessarily the seller or the buyer it was dealing with, but can be anyone. So let's say you bought so let's say I bought the uh, the five tomato for $5, and now I bought it and I want to now sell it for, let's say, five tomato for $10, but I'll make a $5 profit. Okay, which means that I have to find another person or another buyer who wants to buy from me and pay the $10 I am asking. You get it? So this means that the broker has a job just to fill match and fill. So match and fill orders. And so in my case, the broker has to find me someone who wants to buy at uh, $10 and for five tomatoes. Yes. So when a broker finds me that and fills it, which means I become an open interest. All right. And now, so from that open interest, I now determine whether I make a profit or a loss. Because in my case, I can still buy the five tomato for $5, and maybe I won't find someone who wants to also transact business in five tomato for $10. I might get someone who wants to do it lesser at a lesser price, which means I'll make a loss. So at that point, we determine our profits and loss. So I want to go deeper to this for those who are or who would already have knowledge about this. So in Forex, when you buy and you want to go out of the market, you need to sell. So when you buy and you want to go out of the market, you need to sell. And when you sell and you want to go out of the market, you need to buy. That's how the forex trading works. This is because when I buy $1, this is not a physical money. So please, this is not a physical money. So when you buy it and when you are going out, you need to sell it to make a profit because it's not physical that you need to take it home. So it's all done online. So which means that you buy what you want to go out, you need to sell it. When you sell and you want to go out or you want to close the trade, then you need to buy. So that's how the forex trading market works. Okay. So now risks in forex trading. So there are many risks in forex trading. We have psychological risks, we have emotional risks, and we also have loss risks. We also have fear risks, or what is known as FOMO. So that's psychological risk. So psychological that's a state of mind. So you can be in a state of mind that you might not have control over yourself, and it's a risk in forex trading. You might not have control over yourself. You start placing trades anyhow, taking losses, and it really affects the way you think, your emotions. So all these are psychology. So when you want to trade the forex market, you have to make sure you are in the right state of mind, that you take good decisions at the right time in the forex market. And have emotional risks. So emotional risks is your emotions. Sometimes because of the way the market moves, you decide to just enter the market just because you think because the market is moving aggressively, it's going to continue downwards, and now you place a sell trade, and now the market reverses and take you out. So these are all emotional risks because of you are dealing with your emotions. You're dealing emotions, and these are risks in the forex market. And we also have loss risks. So it's not always that we're making profits in the forex market. There are times you are going to take losses and need to accept it. Need to accept those losses in order to move on and grow. So yes, but we want to make sure that this loss risk becomes minimal in order to stay profitable. Yes. Okay, so the next one is the fear risk or the FOMO. So the full meaning of the FOMO is the fear of missing out. So there are times this has explained like the emotional risks. You because of the way the market moves, the market moves sometimes very because of liquidity, it moves very aggressively, and you become fear that the fear that the market may go in your direction, but you won't find a place to enter. Do you get it? So you want to just enter the market, you just click on it, so that's the fear mode. You fear that you will miss out on the trade because you think your prediction is right and the market will go. So you want to just enter the market. You fear that the market will go and leave you. All right. So successful entrepreneurs in forex trading. All right. So there are many successful entrepreneurs out there. Some are legends and all that. And I give great respect to these guys out there. Okay, so these are just some of them. Some of them I know them I know online, yes, and some of them I follow. These are just a few examples. So the first one is Kojo Forex. So this is a Ghanaian successful Forex entrepreneur. Kojo Forex. So we have Jeffrey Benson, that's a Nigerian Forex trader, a very successful entrepreneur. And me, that's Max JFX. That's right there. I'm also one of the successful entrepreneurs in forex trading. We have Alex G. Alex G is also so that's Alex Gonzalez on Instagram. Yes. So he's also one of the successful entrepreneurs in the United States. And we have Warren Buffett. He is also a legend, a well-known legend in the stock market. He trades stock. And he's a very great legend. Respect to him. He has made a lot of billions in forex trading. Yes. So these are just some of them. And the reason why I brought this slide here is that if these people, just like us, humans like us, with emotions, with psychology, have been able to go through all this to make themselves successful entrepreneurs in the forex market, then it means that we too can do it. We too, with the right mindset, the right emotions, the right psychology, we will also get to the right state of mind to become successful. All right. So requirements of forex trading. What is the requirement? What forex trading requires of you. So the first one is that the forex market requires patience, and you need to be logical. You need to be logical. You need to be interpretative. You need to be able to interpret what the market is it wants to do or is trying to do in a particular time frame. And the psychology control, emotion control, working strategy, and a plan. A plan because every forex trader wants to scale up, not just trading $10 for life, but $10 to 1 billion, to 1 billion. Yes, so that's the plan. Requires logic, interpretative, psychology control, emotions, working strategy, patience, and a plan. Please, this is what the forest requires of you and need to take this very, very seriously. Okay, so the tips. So I would advise you that you watch the chart each day on your free time. So if you want to find a chart, just search tradingview.com. Yes, sign up, click on any pair and watch the chart. Please take this very seriously. Try very, very hard to be able to just at least a day, just single day, 5 minutes, 10 minutes, just be watching the chart, looking at what the chart is doing, and that's it. Yeah. So I believe in the mind. So the mind can do something, You can just figure out by just doing small things each day. All right, so this is the end of this lecture, and I would advise you that you like and you subscribe to my channel, like, subscribe, and comment. Thank you very much. Then it is a bye for now. Thank you.